Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at the sector that Jim Cramer believes will continue to grow through the second half of 2021. On a recent episode of Mad Money, Cramer selected 3 solar companies he expects have a lot more room to run to new record highs. So of course, as we continue to transition to more renewable energy sources, the entire solar industry will continue to grow, and he outlined 3 companies that are poised to benefit through 2021 and beyond. So in this episode, we're going to go over the 3 stocks he listed, take a look at their current investor presentation, their current financials, and their future growth expectations coming from different Wall Street analysts. But before we do that, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and of course today, we're going to focus on Jim Cramer, the CNBC analyst, one of the most famous people in the financial world, and the 3 solar companies he believes will continue to run up through 2021 and beyond. And the first stock we're going to go over is ticker ENPH, which is Enphase Energy. They currently trade for around $160 per share and are up a massive 185% on the 12-month chart. They have a market cap over $23 billion with a very high forward PE ratio, right around 86. And this company manufactures and sells different solar home energy solutions, and they offer a semiconductor-based microinverter that actually converts the energy directly from the solar module. And combined with its network and its different software technologies, it allows you to actually monitor and control your services wherever you are in the world. And if we jump over to their investor presentation, Enphase is a leading microinverter-based solar plus storage company. They have shipped more than 34 million inverters all around the world and have approximately 1.5 million systems in place in over 130 countries. So they've proven not only can they sell their products on a global scale, but they can actually be used to generate and convert energy pretty much all around the world. And in 2020, they generated $774 million of total top-line revenue. And if we take a look at this diagram, we can see their all-in-one smart energy system. So the entire process allows the home to collect the solar energy, transform it into usable power, and then actually store that power so it can be used over a prolonged period. And this entire system can be tracked through Enphase's software-based service, the Enlighten mobile app. So overall, they built a system that has the actual hardware products that's directly connected to the software service. So overall, one smart system can collect energy, transform it, store it, and monitor it. So the clients in over 130 countries know exactly what's going on with their different solar-based energy. And over the long term, they have a great plan to actually expand the revenue they can create from every home they install a system. So right now, they have the residential solar that generates around $2,000 of revenue per home right now. And that's projected to go at a CAGR of over 20% for the next 3 years in the future. But adding the storage component so the companies and the homes can actually store that energy over a longer term period is projected to add to over $8,000 of revenue per home going forward, which will help increase the average revenue collected per residential solar installation. And over the longer term, they also plan to expand into small commercial solar, and they have a product coming soon, and they're actually targeting their similar market share that they have right now in the residential solar industry by 2023. And then going forward, they're also planning to expand into off-grid solar energy storage, so they have a blue ocean opportunity, and again, another product coming out very soon. So they have a lot of room to continue to expand and grow and reach new markets over the longer term as the company comes out with different solar energy storage products that we'll see very soon. And if we jump over to their income statement, we can see that year over year, they have continued to grow. $870 million of total revenue during the trailing 12 months, up from $322 million back in 2016. So year after year, total revenue continues to expand, which is a very good sign. And if we take a look at their balance sheet, total current assets of around $1.8 billion compared to short-term debt at only $334 million. So right now, over the shorter term, a very strong current ratio, well above 4 and very sustainable going forward. And if we take a look at the total assets, right around $2.2 billion, not a lot of goodwill or other intangibles, which is a great sign, and it shows the company's actually growing their assets without acquiring other businesses. And if we take a look at total liabilities, only $1.4 billion. So right now, their total cash on hand and their total current assets is more than the entire debt on the overall balance sheet. So I don't believe the company will have any liquidity issues over the next few years. And if we take a look at some future growth expectations, according to Simply Wall Street, analysts are forecasting 43% annual earnings growth over the next 3 years. So if we take a look at where the company is today, $870 million of top-line revenue with $96 million of total earnings. Fast forward over the next 3 years, they're projected to grow the top and bottom line exponentially to over $2.2 billion of total revenue and $460 million of total earnings by year-end 2023. So over the next few years, a ton of future expected growth coming from Enphase Energy. So this was the first of 3 companies Cramer mentioned in his Mad Money episode, where he discussed solar companies that have a lot of room to continue to grow. And now if we jump over into stock number 2, we have ticker GNRC, which is Generac Holdings. They trade for $426 per share, and they've already seen a major run-up of 223% on the 1-year chart, with the market cap at $27.5 billion and a forward PE ratio right around 43. So we can clearly see the company is trading very close to the 52-week high of $452. So of course, Cramer does believe it can run up even further, and that's why he included them in his Mad Money episode. But for many investors, it is very hard to buy a company after such a fast run-up. So maybe add it to a watch list and see if they fall going forward, then it may be time to buy the dip on a leader in the solar energy sector. And we can take a look and see that they manufacture and sell different power generation equipment, energy storage systems, and other power products for residential, light commercial, and industrial markets all around the world. And if we take a look at their current lineup, it includes generators, backups, and beyond standby supplies, and different battery storage systems. And over the next few years, on a 1 to 3 year timeline, they're expected to integrate their different storage capacities with their generators, develop a roadmap for a full suite of grid support solutions, and also come out with new products that are directly connected to the Embala software system, so all the different services can be connected to their software platform. And then over the longer term, we're talking 3 to 5 plus years in the future, they have many different plans to generate revenue from new markets and with new products to expand the company's total reach. And also, they have a great plan for their capital deployment. Over the past 3 years, they've invested in organic growth by doing R&D, growing with their innovation in their technology. They've also done a great job of paying down their debt. They've done a few tiny mergers and acquisitions worth around $240 million, and they've also returned a little bit of capital to their investors at only $25 million. So of course, this company is still early on in their growth and development, so I'm not really worried about the capital they return right now, but the long-term growth and expansion of the overall business. And if we take a look at their financial summary, they've been doing a great job of growing and expanding year after year from 2017 through the trailing 12 months. So we can see back in 2017, they had $1.6 billion of total top-line revenue. Year after year, that number continues to grow to over $2.6 billion in the past 12 months. And what we can see is the actual gross margin is improving as they reach greater scale and hit over 39%. Their adjusted EBITDA is growing year after year as well to around $711 million with an EBITDA margin above 25%, and they've done a fantastic job of growing their total free cash flow to over $563 million during the past year. So if you're a subscriber to the channel, you know I'm a big fan of companies who generate some growing free cash flow, and it's one of my favorite metrics to use when evaluating a business. So for a young company that operates in the solar industry that's fast moving, they have plans for a great expansion going forward, seeing this fast growing free cash flow is a great sign. It gives them the ability to pay down debt, but also fund future growth and development in research and innovation for many years going forward. So I think the company right now is doing a great job on the financial side. They're growing revenue, adjusted EBITDA is expanding, and they're generating accelerating free cash flow year after year as well. And if we take a look over 2021, they expect total revenue to grow by between 40 and 45%. They expect their actual residential products to expand by over 50%. They expect adjusted EBITDA to come in around 25% and free cash flow conversion of 90% overall. So for 2021, they're expecting another great year for the company. And of course, if we jump over to Simply Wall Street, they're forecasting over 12% annual earnings expansion for the next 3 years going forward. And from where the company is today, $2.8 billion of revenue, $455 million of earnings, that's projected to grow to over $4.5 billion of revenue, $750 in total earnings by year end 2023. So a lot of expected growth again coming from this player in the solar industry, Generac Holdings, who creates different power generators and suppliers for residential and commercial use at this current level. So they were stock number 2 that was included in Cramer's Mad Money episode. And now if we finally jump in to the third and last stock we're going to go over in this episode, it is ticker FSLR, which is First Solar. They currently trade for $82 per share and are up by 40% on the 1-year chart. They have a market cap at $9.5 billion and a forward PE ratio right around 21. So this company operates and manufactures different solar energy products and is pretty much a main player in the industry right now. But compared to the first two companies we've gone over, they haven't seen as fast of accelerated growth like the other two brands in Generac and Enphase Energy. Over the past quarter, they generated $1.96 of earnings per share and have a $1.5 billion net cash position. And if we take a look at the income statement, over the past few years, the revenues have been pretty much flat. So it's not the best sign from a company we're expecting to grow and that's operating in a growing industry. And we can see back in 2016, $2.9 billion of total revenue, followed by another 2.9, then down to 2.2, just over 3 billion, 2.7, and now just under 3 billion during the past 12 months. So they've hovered around 2.9 to 3 billion for the past 5 years, which is good that they're maintaining, but we want to see the company grow. So that's why I included them as the third stock. Cramer did mention them as his third holding, but I put them at the end of the video because compared to the other two, I don't think they're going to grow at such an accelerated rate. And we can see over the past year, they have generated $517 million of total profits, which is a good sign as well. And if we take a look at the balance sheet, right now the company is in a strong financial position, which is a good sign at least, with around $3.1 billion of short-term assets and short-term debt at only $670 million, so a current ratio safely above 3 and very sustainable over the shorter term. And right away, if we take a look at the total assets on the balance sheet, $7.1 billion with very little goodwill and other intangibles. So I like that. This company is not only growing because of acquisitions or different expansion projects. We can see right here, goodwill and intangibles have been downward sloping for the past 5 years, meaning the company's total assets are expanding in the natural form. And if we take a look at total liabilities, only at $1.4 billion, and overall they've done a nice job of reducing their long-term debt at over $460 million, back down to $250 million over the past year. So they've been paying down debt, improving the healthiness of their balance sheet, and overall I do think they're in a pretty good financial position for a company at this stage of their growth level. But if we jump over to Simply Wall Street, they actually believe the company is extremely undervalued. They believe the company is 56% undervalued at this current share price, right around $80 per share, have an estimated fair value per share at $198 per share. So it's different. The other few companies were estimated to be right around their fair value at this current level or slightly overvalued because of the massive run-up they've seen as of late. But taking a look at First Solar, the company that hasn't seen that much revenue growth, has been pretty much flat over the past 5 years, is expected to be trading at a significantly undervalued level. And with Simply Wall Street, they generate this fair value estimate by using a discounted cash flow analysis, meaning they forecast out all the company's future cash flows indefinitely and discount them back to the current point in time to get a single-digit estimated fair value per share based on future cash flows. And when they do that, they get $197, which of course we can clearly see is way above the company's current level. So if you want to do your own calculation, there's many different formulas online you can do to get a discounted cash flow analysis, and you can see what you think the company is estimated to be at this current level. Cramer included them. Cramer thinks they're a buy, and if we take a look at the exact article, I think your portfolio needs some solar exposure, ideally with First Solar, Enphase, or Generac, the Mad Money host said. So Cramer included the 3 companies we've gone over in this episode on Mad Money as the solar plays he actually believes will continue to grow to new highs. So overall, we went over Enphase Energy, who's up dramatically over the past year with no signs of slowing down. Then we had Generac Holdings, and finally, we have First Solar, the company that's estimated to be undervalued, but has seen very minimal revenue growth over the past 5 years. So overall, now we're going to wrap up the video. I want to thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so. I'm the Gen Z Investor. We talk about different stocks you can buy and any major market news on the channel. So please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.